This is the Global Recast, a series of curated conversations with first-rate and distinguished global leaders on grit, resilience, and courage, the untold stories of their challenging journeys. The goal here is to have a closer look at the inner workings of leadership and optimism in a fractured world. From global policy icons and corporate executives to celebrated entrepreneurs and innovators, we are interested in their unique perspectives on navigating setbacks, triumphs, and everything in between. Beyond the global north, global south binary narrative and the left-right ideological divide, how does courageous leadership help in driving collective action? These conversations happen across 5 domains: global business, global public policy, global innovation, global development, and global diplomacy. So, let's get started. Clearly, global governance is broken. The rules-based international system is under great stress. And as the battle for global influence intensifies, some argue that perhaps it's time to discard everything altogether. With the rise of economic nationalism and inward-looking capitalism, it appears global attitudes are gradually shifting. The idea of relying on some global institutions and international rules to help organize global affairs seems to be losing credibility. Think about the various conflicts around us, from Ukraine to Russia and to the Middle East, and the recent trade wars, and other global challenges. And make no mistake, this is not a global north or a global south issue. This is a universal discussion. At the end of the day, leaders and decision makers are humans with cognitive limitations and indeed emotions. And if we are going to prioritize the power of grit, resilience, and courageous leadership as we beam a searchlight on credible and pragmatic solutions that can help to restore stability and reignite optimism to create shared prosperity in our fractured world, it will be very important that we listen to the untold stories of these leaders, their triumphs, setbacks, and everything in between. And that's my submission. I recently caught up with Thomas Barry, President and Chief Executive Officer of New York-based Zephyr Management, a global veteran in the private equity and venture capital industry. Today, we will examine issues under the global business pillar. We are beaming our searchlight on the global private equity and venture capital market, and specifically under the theme Global Realignment and the Future of Venture Capital. But first, let's set the context. The global system is in uncharted territory. We live in a world in crisis. Following the rapid pace of globalization witnessed in the post-World War II era. Geopolitical risk analysis in the global business domain has largely been a marginal issue, not something fully baked into the mainstream of global business and finance. But not anymore. Tariffs, subsidies, protectionism, and industrial policy are on the rise everywhere. Geopolitical risk is creating challenges and opportunities for firms engaged in cross-border trade and investment, including, of course, private equity and venture capital firms, investors, independent asset managers, and others looking at cross-border deals. And those who fail to learn from history, they say, are doomed to repeat it. From the chaos following World War II to the Great Recession of 2007 to 2009, to the COVID-19 pandemic and the recent global poly crisis, the nexus between geopolitics and market has major implications for return on investment, capital allocation efficiency, and broadly speaking, in achieving the Sustainable Development Goals. The picture is changing rapidly with the new normal we are witnessing in geopolitics and trade. Governments across different regions are scrambling to develop new regulations to gain more control over their intellectual property and digital assets. Export controls are coming back, creating bottlenecks in global supply chains. And perhaps most importantly, the rules-based international order is in jeopardy with rising powers in the global south asking established actors and institutions to give room for multiple centers of power and influence, to allow different civilizations and political economic configurations to live by their own rules and thrive on their own terms. So as the global economy splinters into competing blocs, many in emerging markets and developing economies are calling for an overhaul to reduce the dominance of the global financial system by hitherto powers. In the same vein, President-elect Trump recently threatened to impose 100% tariffs against nations that act to undermine the US dollar, with American firms controlling a large chunk of the global asset under management, which, by the way, stood at $125 trillion as of 2023. Many are wondering what the future holds for private capital allocation in emerging markets. Will the coming years mark significant disruptions and underutilization of capital allocation capacity to the extent that global private capital flows matter? As we navigate these disruptions in global trade and investment flows, geopolitical risk assessment is becoming an increasingly important variable in the mix. So, today, consistent with the style at the global recast, deploying a unique lens of inquiry which prioritizes the views of global leaders based on their own tapestry and intricate journeys of triumphs, setbacks, and everything in between can help us to make sense of these things. Talk about grit, resilience, and courageous leadership. That's my perspective on today's episode. And to help us shed some light on these issues, I do have a heavyweight in the global private equity and venture capital industry with me, with over 30 years of experience deploying capital across emerging markets and developing economies. It's a privilege to have Thomas Barry with me today. Mr. Barry is the president and chief executive officer of New York-based Zephyr Management, an emerging markets investment management company, which he founded in 1994. And over the past decades, they have sponsored specialized investment funds with approximately $2 billion US in committed capital. And the firm has also sponsored discrete funds for private equity investing across Africa, Mexico, Korea, and India. Thanks for joining the show, Tom.
Thank you. Pleasure to be here, Fred.
So before we get started, could you please introduce yourself? I know I just read your short bio, but for the benefit of our listeners and those who will watch this, maybe you can add a few more about yourself.
I've been in some form of investing for many years, and I had an epiphany about 30 years ago that many forms of development and foreign aid were not becoming effective, and that I could develop a business that whose goal is to both do well and do good. Do well in a sense of financial return in an ethical way, but do good in a sense of promoting economic development. So the countries you mentioned that we've gone to, we have selected them because we felt that they were ready and accepting of private sector development to improve the well-being of the people in the country. And so right now we're mostly active in Africa, India, Sri Lanka to an extent, because we think these are places that are inviting and welcome expertise as well as capital to try to improve the economics for the lower and middle class. Most of these are countries that have 80% of the people in the informal economy don't have bank accounts, and nobody's paid attention to these people. Most foreign investors and governments pay attention only to the people in the formal economy, and that's wrong. So this gives us an opportunity, hopefully, to both, as I said, do well and do good.
Thank you very much. That's quite helpful to know, that not only are you focused on the strictly, private returns-based aspect of things, but you're also conscious about economic mobility, as it were, for the less privileged. That's very profound. So to the first question on today's episode, I really would like to look at the ongoing global economic turbulence and capital flows. I mean, as you rightly know, global assets under management, in recent times, AUM has seen significant growth compared to, say, a decade ago, and with further growth expected in the coming years, in spite of all that we've seen these past 4 or 5 years. So as fund managers become more risk averse, and as they try to shift their investment strategies, and we know that investment flows, to the global south, and specifically to emerging markets, we likely see a disproportionate decline. So the question is, how can such impact be mitigated? Or put it another way, how can we even avert this prediction, if you take it as one?
Well, that's a complex situation and question. So I'll try to break it into smaller parts for an answer. First, the developing world operated for many years, as you pointed out, after the Second World War, in the assumption that globalization was good. That was a win-win proposition in respect to providing employment in high labor content goods and exporting them to the developed world. In recent period, there's been a lot of political reaction that globalization had winners and losers, and that protectionism might be a better course. And so the growth of globalization came to a halt about 5 years ago. And so it's no longer accepted as something that's going to naturally happen. And so that, of course, impacts portfolio management and investment decisions. I would also say that developing countries and emerging markets had a long period of stability, both politically and economically, and that's also seems to come to an end. So there's more volatility in political regimes and certainly in currencies. So the currency question has become a huge barrier to investment because most of the capital in portfolio are either euro, dollar, or yen denominated. In many emerging market currencies have deteriorated badly against those currencies, and so therefore you might make a good return in local currency, but not in your home currency. So how to mitigate that? Well, I think there's a major transition away from thinking about investments as country-centric and moving to company-centric. And by that, I mean, rather than saying, oh, country X is a good country to invest in, I'll go invest there. I think it's still problematical because of political changes and currency instabilities in almost every country. Really only China and India maybe have not had currency instability against the three big currencies I mentioned before, the euro, dollar, and yen. I think it's going to be more country-centric because it turns out that in a technology world, first-rate companies can be operated in any country in the world, and they can then do well. So I think the answer to mitigate that, Fred, is to look for companies which can be regional or global early in their growth. So it diversifies the risk politically and economically. Two countries I would mention that have been very successful doing that have been Singapore and Israel. These are both fairly small populations, but they have a focus in each of these countries on being global on day one. Singapore has done a spectacularly successful job at becoming the headquarters for half a dozen countries around them, for companies to go there and have their business there, have their currency there, and their some of their better people. And Israel has also done very well in technology. And on day one, every company in Israel thinks of itself as a global company. So what we do is we try and look in developing countries for smart people who understand that early on in their career, the company's career need to be regional or global.
No, this is very punchy, and straight and direct, Key takeaways there, emphasis on company specific nuances, and also, to look at those that have the potential for high growth and focus that on regional and other aspects. Thank you very much. That's helpful, and I really I love the comparison. The example of Singapore and Israel. I mean, I guess those are two exemplars when it comes to punching above their weight, if you
Correct.
consider population or economic size. Very instructive. I'm going to move on to the next question, which focuses on fund managers. It focuses on small and emerging fund managers. As always, performance is very key, in terms of looking at the direction of capital flows and what have you. And you see that the relative performance of large fund managers is often analyzed in the context of their diversified portfolios. Whereas when you look at small and emerging fund managers, it is often about how nimble they are, their agility and ability to respond quickly to opportunities. However, you would notice that in the post-pandemic economy, since after COVID, investors tend to focus more on large or the largest fund managers. They are continually shifting their investment and new commitments, in favor of the large and established fund managers. So my question here is, how can small fund managers remain resilient? What steps can they take to at least increase the likelihood, of competing well and securing investment, given the highly competitive and unpredictable environment that we operate in today?
This is a very difficult question because scale has become increasingly important in the investment business. And scale, of course, means that extra large companies can be predatory in their behavior and pricing. So I would say two things. First is we should encourage in emerging markets global regionalization to build scale. One of the reasons that these fund managers who invest in listed securities have not done so is that the listed markets are too small. And Africa has, I think, 30 listed markets. None of them are big enough, except for maybe sometimes South Africa and Egypt. Same with Latin America, same with the Middle East. So the first thing is to be able to attract these large fund managers, regional listed exchanges should be developed. And that's important for our second question, which is about venture capital, is in the developed world, a key aspect of successful venture capital is your exit. And in many cases, a key exit is listing on the stock exchange, initial public offering, so-called IPO. And that isn't possible in almost every emerging market. There are no IPO markets. As I said, in most countries in Africa, Latin America, and Middle East, this doesn't exist. So we should encourage these governments and regional exchanges to develop some kind of regional mechanism so they could have scale. That scale would attract fund managers, and that in turn would then become a good place for private companies to list. The second is that in the venture capital business, too much, in my opinion, rests upon the economics relating to the size of the business, not the success of the business. So asset-based fee means that many managers need to get a large amount of assets to be able to pay their staff. And that's inimical to the fact that the amount available that can be invested responsibly can be quite small. So I think there has to be either new formats for the way the fees are charged. A second idea would be what was popular 100 years ago, stock exchange listed companies that became investment vehicles so that they could be perpetual capital and couldn't be subject to redemptions. Or maybe the fund managers have to go into corollary businesses, whether it's brokerage or merger and acquisitions, other things that wouldn't happen in the developed world, but a way to develop economic scale. The thing has to start from the basis that the amount of money needed to invest is not large by the developed world standards. And so the funds don't need to be large, but they need to develop a model which makes it an attractive business for a fund manager to go into.
Thank you. Thanks. And your comment about scale obviously is topical, is relevant, but that sort of gets me thinking. And maybe this question is a little bit unrelated, but I will ask it regardless. When you look at a region like Africa, you know that the whole AFCFTA, the African Continental Free Trade Area, it's a framework that region has recently been advancing to help ensure that issues around fragmentation or limited market size and all of that, right? That for investors coming from other regions, they can see the region as one, and maybe that can help to reduce any inefficiencies or what have you. But what you find is, in spite of efforts on the part of policymakers and other players to better organize their markets and do away with inefficiencies, perceptions about risk and currency volatility and other issues still seem to weigh more or override whatever improvements or reforms, in market size or what have you. So how do you explain that,
The past decade has been pretty discouraging for an investor who measures themselves in euros, dollars, or yen, because if you double your money in local currency, but the currency declines by 50%, you've ended up with no gain. And so I think the governments have to be much more sensitive to this. And I've recommended to every government I come in contact with, they need to develop some kind of insurance mechanism on their currency, because people are reluctant to invest in countries that had serious currency declines, because it doesn't translate into any improvement in the home currency. The second is there has to be more cooperation among the countries, and I think you could have these regional cooperations, but what they need to do is agree on a single common currency and a exchange mechanism, because then you have scale. So scale in government debt, scale in corporate debt, scale in equity, and others, that you will attract global investors. So I think the scale is one thing, and the currencies is the other that should be addressed because I think there's a lot of interest in foreign investment in developing countries. It's just the scale is an issue and the currency is an issue.
Okay, we'll leave it at that. Thanks for your intervention there. Next on my list here is the global supply of public equity. Due to economic and geopolitical uncertainty, we find that the number of private companies listing their shares on global stock exchanges is falling. And I know you recently just talked about limited, exchange sizes, but I wanted to also add that based on recent data, from JP Morgan, the global supply of public equity is shrinking at its fastest pace in at least 25 years. That's profound. In your opinion, why is this the case, and what are you seeing in emerging markets?
In the developed markets, I believe the root cause is that the amount of assets that have gone into private equity funds have enabled these funds to buy and keep companies not listed, or delist companies by buying them, with the thought that without having to worry about quarterly earnings report and the cost of regulation, they could engage in more fundamental economic improvements and restructuring in businesses. And I don't know whether that in fact works or not, but in fact, more and more money has gone into private equity funds. In developing countries, because the listed markets in almost every country are so weak, and I'm going to exclude for a minute India and China, are so weak that almost all the activity is in the private markets. However, they're not delinked, going back to my prior answer, and the listed markets are in many countries the primary exit for venture capital. And so if you have a weak listed market, you just have venture capitalists hesitant to enter these countries because it isn't clear how they're going to sell their shares in the businesses they finance.
Mm. Okay. I like the distinction, and the clarification on China and India. I mean, for obvious reasons, their impressive performance, right?
Well,
Over the past
but I'll make
decades.
2 points. One is their absolute scale is such that they can have an internal market that's big enough to have global investors, and they're the only 2 countries in the world that can do that. But the second is their government and regulatory systems have put a huge amount of effort into building the listed markets. It has been a very conscious government policy to build it, to have regulation, to have transparency, all the things that were needed to do that. And most emerging market governments have not made this a priority.
Mm. Yeah, and because we're talking about China and India, I know you haven't done much in Latin America, but perhaps you can say something about Brazil. What do you know about that market? That's a market I keep wondering why there isn't much success in spite of the proximity to the US, the size, and other dynamics. What are your thoughts on Brazil?
Well, Brazil's the largest country. I don't know if it's the largest economy, but certainly the largest country. I mean, Mexico has had larger capital markets historically. I think the Brazilian government has not put so much effort into having a strong listed market and regulations. But there is a very active venture capital market that's I think quite robust in Brazil. And again, the size of the country is big. The private sector is quite good in Brazil. I mean, if you exclude oil and iron ore, the government is not actively in businesses there. So it's a pretty vibrant private sector. So now, if I were Brazil, what I'd do is try to regionalize. I'd go to the countries around them and say, well, why don't we have a common currency? And why don't you list in our country? And why don't we have an exit vehicle for it? I mean, to become, they could be the dominant regional country. But they don't seem to do that, or the others don't seem to cooperate.
Okay, that's good enough. I hope somehow policymakers and key actors maybe get to see this and act on it, especially the regional bank, the Inter-American Development Bank. I know they are pretty active when it comes to the investment landscape, and I see a lot of reforms there. So I'll move on to crisis. As we started this, the world is in crisis mode, and the scale of what we are seeing, I mean, it's new in terms of the share size. And when you look at what that means for private market investing, there's a lot to unpack. 2 Harvard professors, Michaela Creasy and Amy Edmondson, explain in a recent article the key differences between sudden and sustained crisis, using the COVID-19 pandemic as an analogy. In their precise words, and I'm quoting them now, while the pandemic has ended, many executives are still leading their organizations as if a sudden crisis still existed. Instead, we are now in a sustained crisis, a period of ongoing intense difficulty and uncertainty. End of quote. So the question is, what do you make of this vis-a-vis private equity operators and executives that still view the current global economic and geopolitical turmoil as a sudden crisis? What do you say to those folks?
Well, my own view is that COVID was a sudden crisis, but this retreat from globalization is a sustained crisis. There are many, many countries in the world that are moving away from globalization. We seem to be in a period of less political stability in Latin America, Asia, Middle East, and may or may not be related also in a period of currency instability. These are highly detrimental to developing cross-border investment. And it's sad to see that in Central Africa, we're back to an era of military coups. In Latin America, we're moving to more autocratic governments, and the same in the Middle East. These are scare investors and are, I think, some of the sustained crisis reasons that foreign investment is down, because predictability is so important to an investor. And so if an investor feels a country is politically unpredictable or the currency is unpredictable, they're going to hesitate. And you see, after a period of like consumer goods companies making investment in foreign countries, they stop. Now they say, well, we'll import our goods, but we won't take the risk of making a big capital investment because we don't know what's going to happen. And you may have seen, like Unilever after 100 years said they're going to withdraw from Nigeria. I mean, this is crazy. So I think there are some sudden crises, but those will always happen. I think we have to focus on the sustained crises.
Okay, I wouldn't add a thing to that. Very, very punchy and compelling. Before looking, focus on the sustained crisis. It has to stay. Thank you, Tom. Yeah, and as we try to wind down and bring this to a close, let me ask this next question on, again, geopolitics and venture capital. Increasingly now, it's becoming a game of dominance. As I said in my opening remarks, many developing countries and emerging markets, have repeatedly called for an overhaul to reduce America's dominance of the global financial system. As a global private investing veteran, how may this impact private capital allocation across emerging markets? Again, I said in my opening monologue about the BRICS and the competing blocs and tariffs, but if the call for an overhaul of the global financial architecture, if that does materialize, how may that impact capital flows to the South?
Well, that is a really good question. And I wish I had an easy answer to that, Fred. Clearly, a big shift in our lifetime is that the United States is going from the important country to an important country. And this is difficult for some Americans to accept, and it's difficult for others to make room at the table for China and other important economies. Having said that, though, there hasn't been a good mechanism for global decision making. And while I think there's a lot of good arguments not to have a unilateral system with the U.S. dominant, we haven't succeeded. And like the UN is failing miserably in everything from peacekeeping to health and others. And we really need to try and figure out how to make the UN succeed. So I think the question here is, what kind of system will develop? Now, second part of your question about the dollar, it's nice to talk about alternatives, but there aren't any. So the Chinese renminbi is important currency, but because it's so politicized and controlled by the government, it's not freely traded all over the world. So it's really, at this time, not an alternative. And there's no other currency that is of the scale of the dollar. Now, the crypto people and others think, well, blockchain or some other neutral mechanism of exchange will develop. And maybe there might be something to develop. But right now, unfortunately, there's really no alternative to the dollar. For a while, people thought the euro, but the euro has really gotten weaker. And the dollar, I read somewhere, I'm not sure if this is correct, but I read, interesting, that there's more dollars outside the United States than inside the United States today. Mm-hmm. And so, you know this, right? You travel all over the world. Every little country you go to, if people don't trust the currency, they have dollars in their pocket. And they use that as a way of trying to protect their interests. So maybe somebody will figure out some kind of medium of exchange or blockchain. I think we have to look for ways, not assume there's going to be a dominant country or currency or an easy global decision-making system. I mean, right now, that's just a matter of struggle. And that's why I said I hope the UN will take a more dominant role, or other regional associations will do so. In the absence of that, which you and I have no control over, then we have to go back to our first questions in being properly diversified in terms of the sources of your business. And this is the beauty of Singapore and Israel and others, to as quickly as possible have an investment portfolio and a business which operates in many currencies and countries is the only way I can think of being hedged.
Okay, thank you. And before I ask my last question, following up on that point, what do you think is happening to Europe? And I get it, the political economy and technology and all of the forces, Brexit, I get it. But why right now in 2024, we're discussing trends, things to happen in 5-10 years, and it's all about China, and other regions. What is happening to Europe? I get it, social issues, regulations, and all of the dynamics. But why is Europe missing in action, if I may use that construct?
Well, it turns out the European Union, the whole is less than the sum of the parts. And that's the problem, Fred, that the individual countries have maintained many of their individual characteristics. And of course, the UK maintained its own currency. Right now, though, they're being tested because a combination of the Russian incurrence into Ukraine, as well as Trump's bluster and bullying, may force Europe to unify. which I think would be good. But, you know, you have 1,000 years of history of these people fighting with each other. And whether you can overcome 1,000 years of regional fighting, I don't know. But they really have to make, going back to my first comment, the whole worth more than the sum of the parts, and it's not right now.
Thank you. Very well said. Very well said. And to the last question on grit, resilience, and courageous leadership. As a leader who has deployed capital in emerging markets for over 3 decades now, you've most likely had your fair share of the ups and downs, the setbacks, and triumphs, that define leaders. And as you rightly know, I launched this talk show in the first instance to really get an opportunity to hear, firsthand from these leaders, from their own personal experiences and situations, as it were, in life, career, and all of that. So for the benefit of the listeners and others that may see this at some point, are there any experiences or anecdotes, that you'd like to share? Has any particular setback helped you to bounce back in any way to make you a better leader and to have a better perspective about business, life, and leadership in general?
Well, that's a big question. I think everybody learns from experiences. And so every time I make a mistake or lose capital, I learn something. And it would be petty to give examples of that, but I can tell you the conclusions. First, as an American, I am used to the separation of the powers of the 3 branches of government and the longevity of that the president in the US has much less power than the head of most countries. And so most countries, when the regime changes, there can be huge changes in what happens in there. So I think the first lesson I've learned is, try not to do business with governments in any country, because the term of the government may be less than the term of your investment. And the government changes, and who knows what's going to happen next. And that the private sector has not been recognized because, as I said 30 minutes ago, 80% of it is in the informal economy, but it is huge in most of these countries. And that's the place we try to look where we can have a positive impact and a good return. So I would say the second lesson is, don't focus only on the formal economy, because it's a very small part of a lot of countries. That the informal economy is remarkably active, intelligent, growing, and operates in a way that we would understand as an American. Good examples, I would say, are things like renewable energy. In many countries, everybody talks about it, but it's reliant upon subsidies or government action or whatever. And so it's been really a graveyard for investors because all you need is some little government change, and then your business is no longer viable. Government cooperation has been a big problem for us in Latin America and Africa. So we have failed when we've tried to invest in, for example, banks or insurance companies or other financial companies that would operate in multiple countries, because every country has its own regime and its own regulatory regime. It's very difficult. It's not as easy as operating within a single country. I would also say, returning to an earlier point, is regional and global diversification much earlier in the life of a business. It's counterintuitive. As an American, I learned, do one thing, do it well, and then when you've got it mastered, then go on and do a second business line or second country line. I've reversed that in developing countries because it's just too risky to be in one political or economic regime only for a business. The government needs, if the government changes or the currency changes or something like that, a lot of hard work can be nullified. So I would say counterintuitively to reverse the progression to develop diversification in business, in currency, in countries earlier than you would in a developed country.
Thank you. To summarize that, be careful, before you do business with government, and of course, diversification. Very, very punchy and compelling. And that does it. Thanks so much, Tom, for taking the time to share from your wealth of experience, in emerging markets and across other regions in private equity, in venture capital. I really would like to thank you for making our time to join this episode of the Global Recast. And I hope to keep the conversation going with you. Thanks a lot for your time.
And thank you, Fred. I admire so much your work, both academic and practical, in improving opportunities for globalization. First understanding and then action in globalization. I admire it very much, and I hope you continue your good work.
Thank you very much.